Here is Investment Director Monica Hsiao.
Hi, I'm happy to be here to introduce the Asia credit markets. I'm going to start by giving an overview of the characteristics of the market, and then I will follow up with answering the question as to why Asia credit markets are an attractive investment opportunity. So let me start by letting everybody know that Asia credit is actually the largest emerging market offshore debt market, and it has been since 2011. Many people may not know this. It is actually, Asia credit market represents already 45% of the global EM credit markets, and that's around 1.6 trillion US dollars in hard currency bonds, and it's comprised roughly 40% in high yield and almost 60% in investment grade. Our markets have grown over 4.5 times over 10 years. So we started at around 350 billion in 2010 to now 1.6 trillion. This has been driven by the growing annual issuance. So in 2012, we were issuing around 120 billion per year to now issuing between 300 to 340 billion per year of new additional bonds. So let me get to the next slide, which shows you the composition. The Asia credit market is primarily composed of Chinese issuers. One of the main characteristics is that you can see China has grown steadily over the years. From 2009, China had represented less than 5% of the new issuances. And now today, it's about 60% of the new issues that are coming. So that in total, Chinese issuers are dominant with 54% of the outstanding Asia offshore debt market. If you look at the next slide, as much as the offshore markets have grown, it's still actually a drop in the bucket compared to the onshore China markets. So if you just look at that region, China onshore market is now the second largest in the world and surpassed that of Japan. I think one of the most interesting things for funds like ourselves is that unlike the rest of the EM markets that is mostly comprised of sovereign and quasi-sovereigns, Asia offshore credit markets are predominantly corporate bonds. And so it's, basically a ripe playground for those of us that are seeking value in event space and fundamental credit. And see, furthermore, you can see that the corporate bond market representing 41% of that, about 64% is China alone. In the next slide, you can we see that on the valuation side, we actually think that China and the rest of Asia credit markets overall offer attractive valuation, because if you look at the fundamentals here on the two slides, on the left side you see investment grade corporate metrics, and on the right side high yield. Actually this year the fundamentals have remained relatively stable throughout the pandemic. In fact, if you look only at interest coverage ratio, which is one of the metrics we look at for liquidity measures, in investment grade side, there is quite a decent improvement. And you can see from 8 times to 9.3 times, whereas on the high yield side, it also incrementally improved a bit. And I think that says a lot about the ability of Asia to be resilient through that period of time. We did see a slight increase in net leverage in the high yield side, but overall, from the debt service perspective, they have still maintained a pretty good liquidity and ability to service debt. The next slide, we can see that actually the default rate is substantially lower in Asia compared to the US default rate, which is almost double. We ended up below 4%, around 3.5% default rate last year in 2020. And this year, it's expected to remain low at around 2.4%. One of the things that has been in the news a lot is about onshore China defaults. In fact, it is in the news quite a bit because there were some high-profile larger company defaults, but the total number of defaults, in fact, came down from 42 last year to 27 this year. It's just that this last year, the defaults were concentrated in fewer companies and primarily state-owned enterprises rather than spread across private entities. On the next slide, we show here some charts here that demonstrate that value is actually cheap by historical standards, and even if you look at an absolute scale, high yield to investment grade spread ratio, and these are broad metrics. Of course, you have to look at name by name, but on a broad metrics perspective, you can see that it's actually at multi-year highs in the ratio of high yield spread. And particularly if you look at the differential spread between China high yield within the Asia high yield space, in fact, China high yield is to us the cheapest right now within our markets. So we do have a preference of high yield over high grade right now. The next slide. If you compare it globally, it also represents an attractive valuation. Relative to the US high yield, if you take the example of looking at single B space, and in particular China, as outlined earlier, why we think that China valuations are cheap. Just as a demonstration, like the singles B space in China right now pays over 3.5% in some instances over similarly rated US high yield bonds. So, we do think, and especially the last week and a half, there was some backup of spreads. And so, actually, especially in the front end of the curve, there's a lot of value that you're being paid for relative to an actual default rate that is fairly low. On the next slide, so away from valuations and also fundamentals, the technicals are also fairly positive. Asia overall has been underweighted by allocators and global funds for some time now. And so as people are starting to warm up to Asia credit and realizing, the opportunity in the space, it only takes a little bit of a move in the needle to absorb the supply that is coming this year. We actually, in Asia, we have a very particular characteristic where, locals are very supportive. And so you can see that by new issue allocation, Asia is taking up, a big chunk of the new issue bonds. And this also has meant that historically the adjusted volatility has been relatively low. That aside from that, the supply for this year, even if gross supply will be rising a bit, the net supply, in fact, will be falling because of redemptions. So the net financing needed is actually going to be dropping slightly. And finally, we'll just talk about briefly on the China policies. So we recently have had a number of policies that come out that I think if you look at the overall theme, the Chinese regulators are quite focused on overall deleveraging still. So there was a bit of a pause on this in 2018 when, I think they probably felt at the time they may have pushed the envelope a bit too quickly, especially when the trade war started. So they put that on pause for a bit. And then, of course, the last year, we had the pandemic. But instead of actually, pumping in a lot of liquidity the same way that the Fed has. They did do some of that, but they were relatively measured. So overall, this year, we do expect them to either stay somewhat neutral or maybe tighten a little bit. But what they have done is taken targeted initiatives. So they were targeting, in particular, since last half of the year, property sector and also fintech. And I think the themes that we can see are that they want to create a better environment for reform of the markets. They want to prepare the domestic market in order to have a behavior that is more market oriented. They were particularly focused on preventing monopolistic behavior of the domestic digital platforms, and they felt the need to assert themselves to have a more of a supervisory role in certain sectors. And so property, for example, they have always been intent on curbing animal spirits from property developers to excessively buy land and sit on them. So they had policies to encourage developers to accelerate the turnover, and at the same time, they came out with guidelines and then later on set it more in stone for both on the banking side to put a cap on how much financing they can provide in the property sector, as well as on the property developer side, guidelines for them to comply with in order to keep within bounds of liquidity measures, gearing, and so forth. So I think what we see is that they are pretty smart in taking a targeted approach in order to adjust levers there. And then on the fintech side, I think it was appropriate for them to feel that the early curbing that they had done for the retail platforms of the PP side, they needed to apply similarly to some of these digital platforms that were taking over the banking role for consumer finance, for example. And, they were taking deposits, they were lending, and yet without the capital adequacy requirements that they felt necessary to reduce systemic risk. So that's the gist of the direction that we're going with the policies. And ultimately, they care a lot about accelerating internationalization of the renminbi. So, all of this sort of plays into preparing the markets to invite more foreign investing over time. So that's pretty much, the recap. Thank you very much.
Thank you, Monica, for giving us that recap. And before you started Triada Capital, you were actually a lawyer in New York. And now you mentioned the trade wars. There's been a tough situation between the US and China. How do you think a new president will affect the situation? I think that with Biden coming in, I do think everything still rests on diplomacy. So I would say that it's less about the laws presently as it is about how the president will choose to use his power of executive order. I think
the expectation is that the issues that the U.S. has with China, whether it's about talking about trade or technology and so forth, these issues don't just go away and they will need to be negotiated. But that with Biden, there will be more official channels as opposed to policy by Twitter. Then what remains to be seen is how they work out through the antagonism of how China has handled the virus, for example. The other issues that are always simmering, the South Seas, what to do with Taiwan. We have still some of the tensions over the national security law being enacted in Hong Kong. All of these issues still exist despite the change of administration, and many of these issues are bipartisan. But I think the way that they will handle the negotiations or talks will be different, such that we do have some confidence that they can navigate through.
Thank you so much, Monica. And you are going to stay with us. So if you watching have questions for Monica, you can send them in and we'll bring that on later. But we're going now to have a big picture approach. We're going to see the structural case for the emerging markets. And we have with us the portfolio manager of SKAGEN's Kon-Tiki fund, Frederick Pierland. The word is yours. And now we're going to hear from Frederick Pierland, the portfolio manager of SKAGEN funds. Kon-Tiki.
And thank you, Monica, for a really great introduction to Asian credit markets and the opportunities that you see there. I just want to spend a few minutes giving a brief overview of emerging markets equities and why we, as Monica does in credit, see some very attractive opportunities supported by secular drivers, as well as attractive valuations compared with other markets and opportunities. As many of you will know, SKAGEN has a long and proud history of active value investing in emerging markets. And I just want to share with you some of our current thinking on why we remain unequivocally bullish on this asset class, which is still rather young. In an age of information overload and shorter investment horizons, it's sometimes challenging to see the proverbial wood for the trees. So I hope that by taking a step back, we hope we can impart some of our enthusiasm for this asset class onto you, and also why it offers rich pickings for active and long-term value investors like SKAGEN. When I say young, I mean just that. Emerging market equities as an investable asset class only goes back to 1988 when MSCI launched its emerging markets index. In fact, you'll later hear from one of the absolute pioneers of EM investing, Mark Mobius, who launched the Templeton Emerging Markets Trust back in 1989. At the time, EM equities was defined as 10 countries, accounting for less than 1% of the global equity market. The index was actually dominated by just a few countries, with Malaysia and Brazil making up 50% of the index. It might seem strange today, but the index also included Portugal, but there was no China, no Taiwan, no Korea, and no India. And these four countries now account for almost 75% of the index. By the time our fund, SKAGEN Kon-Tiki, was launched in 2002, the EM universe had grown to 27 countries, but it still represented only 4% of global market cap. Today, there are still about 27 countries in the EM index, but it now includes almost 1,400 securities, accounting for 13% of global equity market. So as you can imagine, our opportunity set has grown markedly, but it's actually even greater than that. We estimate that there are more than 3,500 securities in emerging markets having a market cap over $1 billion. These are not included in the index, many of them. And if we consider how the actual investable universe has developed over time, we see significant changes at the country level. So 20 years ago, the index didn't really accurately reflect emerging markets economies. Instead, it reflected where you could invest. And as a result, there was a significant mismatch between the weight of a country's GDP, shown on the left-hand side of the chart, and the country's weight in the index, shown on the right. If we take China as an example, which was included in the index in 1996, it accounted for less than 1% of the index, despite the relatively large size of its economy, even back then. So if we fast forward to today, and we see a much more balanced picture between the respective sizes of economies and the country weightings. Again, if you look at China, it now accounts for 40% of the MSCI EM index, effectively matching the relative size of its economy. And I think this massive change reflects, amongst other things, the rapid development that we've seen in the local capital markets, but also increasingly good access for global investors. However, as the internal mismatches between the various economies and their capital markets within the EM reduces, we believe that in the same way that Monica does in credit, that company fundamentals will become increasingly important differentiator of returns, which favors fundamental investors like ourselves. So despite the already massive developments over the last 20 to 30 years, emerging markets continue to enjoy secular tailwinds of growth and capital market development. And I think some of these are quite easy to overlook in the short-term data that dominates our news feeds. So if we start on secular growth, the chart on the left shows the weighted average economic growth of emerging and developing economies relative to those in advanced economies. As you'd expect, developing countries tend to grow faster, but what is key is the consistency with which they do so now. So every single year during the last 20, emerging economies have grown faster than developed ones. While individual countries may experience periods of cyclical booms and busts, emerging markets in aggregate do not, because of the underlying drivers of superior demographics and the relative productivity gains that they enjoy. We believe that this has much further to run, both at a macro level, but more importantly for us as investors, even more so at the capital markets level. So the chart on the right on the slide shows the global population and economic share of the countries in the MSCI EM index, and compares it with the relative size of their capital markets. So we still see that more than 60% of the world's population and 40% of economic activity still is only reflected as 13% weight in the global index. And I think crucially, according to JP Morgan, it accounts for less than 7% of the average global investment portfolio. And I think it's this mismatch that long-term investors can take advantage of, and the inevitable closing of the gap that will happen. And that's just what has been happening historically as well. So if you look back to the launch in 1988, the EM index has returned almost 2,400% in US dollars. This is more than 10% per annum, and actually more than 2 percentage points more than in developed markets. That means that over the full 32-year period, total returns in emerging markets have been more than double those of developed markets. But it doesn't happen in a straight line. Here we see that the returns measured over a rolling 12-month period in blue have been highly volatile over the years, and much more so than those of developed markets shown in green. It's almost uncanny the regularity with which emerging market equities suffer sharp drawdowns of 20% or more. However, it's also worth bearing in mind that they've also delivered regular periods of phenomenal annual returns of 60 to 70%. And if we take a step back, we see that there's actually been a relatively marked pattern of emerging markets' relative return versus those of developed markets, at least over longer periods. So here we show that the rolling 5-year returns of EM relative to developed markets, and you can see that they're distinct and long cycles. So these have ranged from more than 20% annual outperformance in the late 80s and leading up to the financial crisis to more than 20% annual underperformance during the Asian crisis of the late 1990s. I think more recently, the combination of the China growth slowdown and the subsequent collapse in commodity markets led to a period of significant underperformance culminating 5 years ago. So if we consider what drives these long and distinct periods of under and outperformance, I think, again, it's worth taking a step back rather than focus on discrete events. And as fundamental value investors, we believe that ultimately the shareholder returns come down to the underlying company earnings and the price that you have paid for those future earnings. And again, if we look at the chart on the left, it shows the fundamentals of EM equity companies have in aggregate been pretty good. Over the last 20 years, they've delivered annual return on equity of 13%, which is roughly 2 percentage points higher than those of developed markets. So all else being equal, this should result in consistently higher shareholder returns, as has been the case for the 20 years as a whole. However, the price paid for those returns have fluctuated, often dramatically over time. And this is what has had a big impact on returns of individual investors. As seen on the chart on the right-hand side, EM equities have traded at very different prices relative to those of developed markets over their 20-year period. Over this period, we've had discounts as low as 50 to 60%, all the way up to a slight premium compared to developed markets. And as a result, the relative returns of investors have been driven by these significant derating and re-rating cycles on top of the fundamentals earning cycles that we've experienced. So from where we're looking today, not only have emerging markets companies started to deliver higher returns again than those of developed markets, but you can still access those earnings at a roughly 30% discount to developed markets. And of course, there are always good reasons why individual markets or companies should trade at least temporary discounts. And these can reflect higher political or regulatory risk, less sustainable economic or business model, or even, as Mark Mobius will go through, weaker corporate governance and improvement potential there. That being said, none of these issues are new, nor do they, as the historical data show, detract from the long-term secular drivers that underpin emerging markets. So in effect, investors have been and will continue to be, in our view, rewarded over the long term for higher perceived short-term risk. Another factor that we believe favors long-term investors is the continued development of local capital markets. So unlike in developed markets, where institutional investors such as pension funds, mutual funds, and hedge funds account for the vast majority of listed assets and trading, many larger emerging markets are still dominated by retail investors. Many of you will have followed the increasingly speculative boom in US retail stock market trading over the last 6 to 12 months. But I can assure you that this pales in comparison with emerging market speculation at times. So currently 20 to 25% retail participation in the US is high compared to the 10% we saw in 2019. But it's just a fraction of the 60 to 80% proportion that we see in markets like India, Korea, and onshore China. And as a result of that, holding periods tend to be shorter. And if we use an extreme example, Goldman Sachs data on the right shows that the average portfolio turnover in the domestic Chinese equity market back in 2015 was 18 times. This means that the average holding period of investors was just 3 weeks. And at the time, I was working for the Norwegian Sovereign Wealth Fund in Shanghai, and I could observe this mania firsthand. And at the time, the price setting in the market was not driven by company fundamentals. It was not driven by the sustainability of their business models or long-term fundamentals. Instead, market prices were driven by market liquidity and a second guessing of where that liquidity would go, chasing short-term returns. And as long-term investors in this market, we were able to capitalize on the speculative herding behavior that we saw and protect ourselves from the inevitable bust that came, but also picking up long-term bargains along the way that have been left behind by the crowd. And this is clearly an extreme example, But I think it's really important to stress that the freedom to go against the herd and the fundamental toolkit to back it up are, in my view, an essential part of any investor's toolkit, but especially so in more volatile and less efficient markets that we encounter in the emerging economies. So in summary, our long-term enthusiasm for emerging markets is founded on a really simple premise. By combining above average quality with below average prices, investors can achieve attractive long-term returns. As it happens today, EM Equities currently offers the necessary combination of these superior fundamentals and lower valuations. Now, the cost of admission to this market is somewhat higher volatility, but in our view, this merely reinforces the advantages that long-term investors enjoy, and those who are willing and able to stay ahead of the herd, that will inevitably follow.
Thank you so much, Fredrik. Thank you so much, Fredrik, for giving this structural approach to emerging markets. And Monica Hsiao in Hong Kong, you have been listening to Fredrik. Do you have any comments to what he's saying?
No, I think we actually are broadly in agreement. I think that one of the points that Fredrik touched upon, which is the development of local markets, is very important to, the structural growth of our credit markets as well, because we have a phenomenon that you don't have in the West, which is this concept of onshore and offshore markets. So the development of the onshore credit market, the development of, equity markets as a more institutional class, the reforms that are happening from China that is trying to make everything more market-oriented and to invite more, not only foreign investors, but also domestic retail and investors to look at things in a commercial market-oriented way. All of this, contributes to a multi-year structural growth.
And Fredrik, you showed us also the higher risk sometimes implied in the emerging markets. What is the key risk you see in Chinese market these days?
Well, I think, as we have seen most recently, is that regulatory intervention has had a big short-term impact on some of the larger companies, particularly in the internet space. But I think, again, if we look at longer time periods, we have also seen that any sort of mention of trade war and flaring up of that could also be taken negatively in the short term. But again, I just want to stress that for us, this constant focus on news flow and volatility in the market often gives rise to some of the best opportunities that we have found. And in 2018, for example, we used the weakness in the market to add to our position in Chinese companies.
And Monica, a feature of the Chinese market, of course, is that there is a limit to foreign ownership in companies of 30%. How is that affecting investments?
Actually, this doesn't really affect our credit markets so much from the existing bonds perspective. That's really not so relevant in our markets. But I would take a bit of time to just address what Fredrik was alluding to on the ban, the blacklist of companies with military ties. This actually does, cause sentiment changes of risk sentiment in our markets, similarly to his markets in equity. And, I think the sentiment can shift very quickly in EM markets with a herd mentality. And there could be a lot of fear that I agree with Fredrik, it's short-term volatility that can create, dislocations. Ultimately, on such interventions, I think it depends on how you look at it, right? There's short term and then there's longer term. It's not really a bad thing, in my opinion. For example, the crackdown on the internet platform. that these platforms really were doing some of the work of the banks, and so why shouldn't they be subject to similar supervision? Why shouldn't they be subject to capital adequacy ratios and so forth? So I think some of the interventions and reforms, make sense. You can argue about how they do it, but I think the intention is there to try to, reduce big monopolistic, I think some of the monopolistic practices they don't think is good for long-term growth and to sustain the job growth of the smaller private companies. And then the other main theme is really about some areas that may cause a systemic risk. They're attacking like very early on, so that they make sure that there are more explicit guidelines and constraints around what people can and can't do.
Thank you so much, Monica, and thank you to Frederick Bjelland, who is with us from Stavanger and the SKAGEN Kon-Tiki Fund. And we're going to move on a little bit with Monica. One question for you, which is about females in finance. You are one of relatively few, and what is that like? Is there any particular challenges?
Yeah, I mean, actually in Asia, there are quite a few females in finance broadly. So you'll have a lot of women in banks and so forth. But it is true that there are very few of us that are founder owners of hedge funds and CIOs. So in the C-suite positions, there are still relatively fewer women, and that's a global issue. I think less than 3% of global hedge funds are, owned or managed by women or minorities. And I happen, I guess, to sit in both camps. But, I think one of the challenges I had not expected when I started Triada was actually how that potentially hampers, how you raise funds, because, there have been many research pieces written about how women generally perform on average better over time than men and manage downturns relatively better as well. And yet, they on average also don't raise as much money despite the performance. So that is definitely one of the challenges. And I think it's hard still to explain why exactly that is, but I'm sure part of it rests on how maybe global allocators, think about their approach, and there may be some subconscious biases on how they evaluate managers. But again, that is quite, that's speculation. But that is one of the challenges.
Yeah. Thank you so much for being with us, Monica Hsiao from Hong Kong. And we're going to pick up on women in finance. And we have with us now SKAGEN's investment director, Alexandra Morris. And you have been an advocate for more women in finance for quite some time. And this week you have a piece in the Financial Times advocating more female CFOs. Why does gender matter?
Well, I think there's a general feeling out there that a better gender balance does give a better performance. In the investment banking industry, where we are, around 1 in 10 females are among the professionals. So I have really set my eyes on improving gender balance in our industry. And I've been advocating it to universities, to conferences. I've initiated research reports. And I'm also leader in the Norwegian Women in Finance initiative, where all the major investment banks, including the oil fund, are members. When we're really trying to increase the number of females in investment banking and retain the ones we have.
But is there any evidence that this works, this pays off?
There is a lot of research going on in this area, and most of it points to that it's at least on par. And I think one of the largest ones that have ever been done is the one by Fidelity, where they have analyzed 8 million investor accounts and found that women are superior investors to men by about 0.4% per year. And as Einstein said, compounding is the eighth wonder of the world. 0.4% can add up to a lot of money.
Mm. And you're also, as you said, you're investment director, and your philosophy is active and it's value-based. And what exactly does that mean?
Well, many investors look upon value as a factor, i.e. low valuation equals value. Low price book or low price to earnings. But we all know that just because something is cheap, it's not necessarily a good buy. So at SKAGEN, we take a broader view of value, and we look at those companies whose assets or earnings potential are not adequately reflected in the share price. So we like to say that we want to buy a dime for a nickel or a dollar for 50 cents and avoid those stocks that are fully valued, where you are dependent on growth to actually increase the share price.
I looked at your web pages, and it reads, "Our curiosity grows when others are negative, and we often find value in unusual places." What is the most unusual place you found value in 2020?
Well, I think it will surprise you when I mention a stock called AirCap Holding. Now, this is a company that we in SKAGEN know very well. We've analyzed it and we understand the business case. But this is the world's largest aircraft leasing company. So, you know, I think it would scare the living daylights out of most people going into a stock like that. But because people, when the pandemic hit, really had a lot of fear for this company, they fled. And of course, when the share price tanked, we became very curious and we became greedy. And we understood the case. We understood that they did not have liquidity problems. And we went in and bought the share. And that has been a very good performance. It has more than doubled since the bottom in March, April.
Wow. And keeping to value, it's been out of favor for some time, we have to say that. And why should people go for value now?
Well, it certainly does look like the stars are aligned this time around, and there are several forces in play here. One, you have the COVID vaccine, so investors will start looking towards the COVID losers away from the COVID winners. And second, you have fiscal stimulus plans, both in Europe and in the US, and that will help countries ignite the economy and create jobs. And then you have low valuations, like Michael Lewis was alluding to. There are large portions of the market that are very lowly priced right now, even in a market record high valuations. And then you have of course, the economic expansion that we're expecting once the vaccine is in play.
Yeah. If there is sustained value rotation, which companies do you think will benefit from that?
Well, many companies will. I can point to finance will benefit from a steepening yield curve, and you have industrials and energy and material stocks because of the fiscal stimulus plans, and of course you have real estate, leisure, travel because of the COVID recovery. And I would also like to point to small caps as an area that has been lagging very much. But something that we haven't mentioned here is, of course, emerging markets. You have a huge valuation gap, and it will benefit from all the above I've just said. And also, like Michael Lewis was alluding to, the dollar. The dollar has weakened, and if that continues, that will really boost the emerging market stocks.
Thank you so much, Alexandra Morris, Investment Director at SKAGEN Funds.
Thank you.